Chapter 4. Reconciliations. 4.1. Reconciliation of bank statements with cash journals to prepare a bank reconciliation statement. 4.1.1. Bank account versus bank statement. The bank account in the general ledger is where the entity posts the totals of the cash receipts and cash payments journal every month to determine the balance of the funds that the entity should have available in their bank account. Remember that the money in the bank account is an asset to the business, and that the bank account increases on the debit side when money is received and decreases on the credit side when payments are made. So if you go to your T account for bank, it increases on the debit side with all your receipts and direct deposits, and it decreases on the credit side with all EFT payments and deductions. The bank also keeps track of all the bank transactions regarding the business to determine how much money the business has available according to their records. At the end of every month, the business receives a bank statement from the bank. It is also possible for the bank to generate an electronic bank statement at any time if the business is registered for internet banking. The bank statement is the account of the business in the bank's records and is done in the form of a creditor's ledger account. It reflects all transactions concerning the business and of which the bank is aware. It is important to realize that the bank regards the business as a creditor if the business has money in the bank. All deposits made by the business will mean that the bank owes money more to the business and will be credited on the bank statement. Every time the business withdraws money, it will mean that the bank owes less money to the business, and the amount will therefore be deducted on the bank statement. The bank statement. Debit is all EFTs, deductions, bank charges, and interest levied. Your credit will be all deposits made, direct deposits, and interest earned. So your balance, credit balance is equal to assets, and debit balance is equal to overdraft. So if you have a credit balance, you have a favorable bank account. If you have a debit balance, you've got an unfavorable bank account. If the business has a favorable or positive balance according to the bank statement, it means that the business has money in the bank and that the bank owes money to the business, and therefore the bank statement will show a credit balance. If, on the other hand, the business has an unfavorable balance or overdraft according to the bank statement, it means the business has withdrawn more money than there was available in the account, and consequently the business owes money to the bank, and therefore the bank statement will show a debit balance. Every month there will be transactions that have already been recorded in the cash journals, but of which the bank is still unaware of. For example, EFTs recorded in the cash payments journal, but not yet showing on the bank statement, or deposits made and recorded in the cash receipts journal, but which have not yet been recorded on the bank statement by the bank. There will also always be transactions that have already been recorded on the bank statement, but which have not yet been entered into the cash journals. For example, direct deposits made into the business bank account, bank charges imposed by the bank, or interest earned or charged. In short, the balance on the bank statement and that of the bank account will almost always differ because of transactions that have not yet been recorded in both the records of the business and the records of the bank, or because of errors made by one of the parties. 4.1.2. Bank reconciliation process. The reasons for the difference between the balances of the bank account and that of the bank statement must be determined, and entries must be made to rectify these or to explain the reasons for the differences, so that they can be monitored easily later. If the bank statement shows any amounts which are seen for the first time by the business, they can merely be added into the bank account or cash journals of the business, so that the transactions are reflected into the financial records of both parties. Should it appear from the bank statement that the business has made an incorrect entry or an error in one of the cash journals, for example, an amount was recorded as too much or too little, these errors can be corrected by making a counter entry in the bank account or in the appropriate cash journal. The entity can thus immediately enter any increases, decreases, or corrections of errors in their records to calculate the correct balance of the bank account. Since bank statements cannot be brought up to date immediately and errors must first be investigated before they can be corrected, it would not be possible to monitor corrections and additions made by the bank immediately, and thus an alternative process must be followed. The entity will have to record transactions that they have already been entered into their records and which have already increased or decreased the balance of the bank account, but which have not yet been recorded on the bank statement, or errors that might have occurred on the bank statement in such a way that they can be monitored when they receive the bank statement from the bank at the end of the month. It is possible to obtain a bank statement at any stage during the month to monitor whether the errors that have been made by the bank have been corrected and whether outstanding transactions have been recorded. However, it will only be possible if the entity has access to the necessary internet banking facilities. The entity will prepare a control statement, namely the bank reconciliation statement, to enable them to monitor whether outstanding items do appear on the bank statement and if the bank has corrected its errors. The bank reconciliation statement contains all deposits and EFTs which have already been recorded as increases or decreases in the cash journals, but which have not yet been recorded by the bank. Furthermore, all errors that were made by the bank are shown on the bank reconciliation statement to monitor whether the bank has corrected the errors. The latest available bank statement must always first be compared to the previous bank reconciliation statement to monitor whether the bank has corrected its mistakes and recorded the outstanding amounts. Here is an extract of a bank reconciliation statement of Yearborg Stores on 31 March 2025. You will have a debit and a credit column. It is a credit balance according to the bank statement, 3,000. Credit outstanding deposits, 6,000. Debit outstanding EFTs, you will then list all your different EFTs. In this case, there were 3, number 236, 237, and 238. You will credit amount incorrectly debited by the bank. You will debit the amount incorrectly credited by the bank. And then we end it with a debit balance according to our bank account. And your debit and credit totals must be the same in order for it to balance. Steps in the bank reconciliation process. Step 1. Record all increases or decreases which occur on the bank statement that have not yet been recorded in the cash journals of the business by making the necessary entries in the cash receipts journal, cash payments journal, or directly in the bank account. Example of increases will be interest on current account, deposits made directly into the bank account of the business like rent income, settlement of account by debtors, bad debts collected. Examples of decreases will be bank charges, interest on bank overdraft, stop or debit orders, for example, insurance. Step 2. Check if any errors have been made by the business in the cash journals and correct these errors by making contra entries in the cash journals or directly in the bank account. Examples of such errors: the amount of an EFT or deposit was entered as too much or too little by the business. Step 3. Calculate the correct balance of the bank account after all the entries have been done and all the errors have been corrected. Step 4. Compile the bank reconciliation statement according to the following. A. Show the debit or credit balance according to the bank statement. B. Credit outstanding deposits which have already been added as an increase in the records of the business, but which have not yet been added by the bank on the bank statement. C. Debit outstanding EFTs that have not yet been recorded in the cash payments journal of the entity, but which do not appear on the bank statement. D. Show the corrections of any incorrect increases or decreases that the bank possibly made on the bank statement. For example, the entity's account was credited with a deposit credited or debited with a deduction that does not relate to the entity. E. Show the debit of credit balance according to the bank account. And F. Balance the bank recon statement by adding the debit and credit sides. 4.1.3. Comparison of the latest bank statement with the previous bank reconciliation statement. A bank reconciliation statement is prepared so that it can immediately be compared to the following month's bank statement to check if the bank has indeed recorded outstanding deposits and EFTs and if errors on the previous month's statements have been corrected. When the latest bank statement is obtained, it must firstly be compared to the previous bank reconciliation statement to monitor whether deposits that were outstanding have added, the outstanding EFTs have been deducted, and any errors that were made by the bank have now been corrected. If this is not the case, the bank must be contacted and an explanation requested. 4.1.4 Outstanding deposits. When money is received by the business, it will immediately be added to the balance of the bank account by entering it into the cash receipts journal and posting it to the debit side of the bank account. The money will usually be deposited into the bank as soon as possible and should therefore reflect on the latest bank statement. However, it might happen that the money was not deposited immediately after it was entered into the records of the business, or that the bank forgot to make the entry into their records, resulting in the deposit not being reflected on the bank statement. The effect of this will be that the business already added the amount to the balance of the bank account in their general ledger, but the bank did not. The balance of the bank account and that of the bank statement will therefore differ. Such a deposit that has already been added by the entity must thus be shown as the outstanding on the bank reconciliation statement, so that it can be monitored whether it was indeed added. In other words, credited on the latest bank statement. 4.1.5 Outstanding electronic funds transfers, EFTs. Once an entity makes an electronic funds transfer, the balance of the bank account is decreased immediately by recording the amount of the EFT in the cash payments journal and by posting it to the credit side of the bank account. The bank shows the decrease of the bank balance of the entity as a debit on the bank statement only once the EFT has been released. The effect thereof is that the entity has already deducted the amount from the bank balance in the general ledger, but that the bank has not done it yet. The balance in the bank account and the balance on the bank statement will thus differ. Such EFTs that have already been deducted by the entity should thus be shown as outstanding on the bank recon statement so that it can be monitored whether it was indeed deducted. In other words, it will be debited on the latest bank statement. 4.1.6 Stop or debit orders. Some payments are made every month, for example, insurance, telephone, water and electricity, etc. The business can sign a stop or debit order at the bank, which will mean that the bank will automatically make payments every month on behalf of the business and will then show these payments as a debit on the bank statement of the business. The effect will be that the bank will already have deducted the amounts from the balance of the bank statement, but the business will not have done it on the bank account. The balance of the bank account and that of the bank statement will therefore differ. All payments that have been done automatically by the bank as per stop or debit order must, when the bank statement is received, immediately be recorded into the cash payments journal or the credit side of the bank account. 4.1.7 Direct transfers and EFT payments by debtors. It is common practice for people who owed money to the business regarding, for example, rental income, debtors payment, etc., to electronically transfer the amounts directly into the bank account of the business. The business will only take note of the fact that the money has been deposited when the bank statement is received. The entries for such receipts are thus only made in the cash receipts journal once the amount appears on the bank statement. The effect will be that the bank would already have added the amounts to the balance of the bank statement, but the business will not have done it on the bank account. The balance of the bank statement will therefore be more than the balance of the bank account. All deposits must have been made directly into the bank account of the business, must be recorded into the cash receipts journal or the debit side of the bank account to also increase the balance of the bank account. Bank charges. Bank charges. The bank charges some costs monthly from their clients into EFT fees, cash handling fees, cost of debit orders, internet banking fees, etc. All of these costs are combined into one expense account known as bank charges. The bank deducts these bank charges automatically by debiting them on the bank statement to decrease the balance of the bank statement. The business will only take note of these deductions when the latest bank statement is generated. The effect will be that the bank would already have deducted the amounts from the balance of the bank statement, but the business will not have done it to the bank account. The balance of the bank statement will therefore be less than the balance of the bank account. All deductions that have been made regarding bank charges must be shown as one combined amount in the cash payments journal of the entity or the credit side of the bank account. 4.1.9 Interest earned or charged. If the business shows a favorable or positive balance according to the bank statement, interest is earned on this credit balance. Interest on current account will be added directly by the bank by crediting it on the bank statement. The business will only be able to see if any interest was added when the latest bank statement is generated. The effect will be that the bank will already have added the amount to the balance of the bank statement, but the business will not have done it to the bank account. The balance of the bank statement will therefore be more than the balance of the bank account. All interest on current account that have been added directly onto the bank account of the business must be recorded in the cash receipts journal or the debit side of the bank account to also increase the balance of the bank account. If the business, however, shows an unfavorable or negative balance according to the bank statement, interest is charged on this debit balance. Interest on overdraft will be deducted directly by the bank by debiting it on the bank statement. The business will only be able to see if any interest was charged when the latest bank statement is generated. The effect will be that the bank will already have deducted the amount from the balance of the bank statement, but the business will not have done it to the bank account. The balance of the bank statement will therefore be less than the balance of the bank account. All interest on overdraft that have been deducted directly from the bank account of the business must be recorded into the cash payments journal or the credit side of the bank account to also decrease the balance of the bank account. 4.1.10 Corrections of errors or omissions. Whenever an error has been made by the business itself while recording an amount in one of the cash journals, whereby an amount was entered as too much or too little, it must be corrected immediately by one of the following entries. If the amount was recorded as too much in the cash journal, a contra entry for the difference must be made in the opposite journal or on the opposite side of the bank account to get the right amount. The details of the receipt or payments will remain unchanged. If the amount was recorded as too little in the cash journal, an entry for the difference must be made in the same journal or on the same side of the bank account to get the right amount. The details of the receipt or payment will remain unchanged. However, if the error was made by the bank on the bank statement, then the bank will only correct it once the bank has been contacted. An entry must be made as follows on the bank reconciliation statement so that it can be checked if the correction has been indeed made on the latest bank statement. If the bank incorrectly added an amount on the bank statement or has shown a deposit as too much or a deduction as too little, the entry debit amount incorrectly credited must be shown on the bank reconciliation statement to check if the deduction has been done correctly on the latest bank statement. If the bank incorrectly deducted an amount on the bank statement or has shown a deposit as too little or a deduction as too much, the entry credit amount incorrectly debited must be shown on the bank reconciliation statement to check if the increase has been done correctly on the latest bank statement.